In today's video, we're going to compare two popular high-yielding dividend growth ETFs. The first being the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD, and the Vanguard High Dividend Yield Index Fund, ticker symbol VYM. We're going to do a lot of comparisons of the two funds by looking at a number of different metrics. We'll start by looking at some surface level information like current yield, expense ratio, holdings, and then eventually move into calculating the total dividend growth rate and the total return of these two funds. As always, be sure to perform your own research and come to your own conclusion before making any investment decision for yourself. But with that being said, let's go ahead and get started. First off, the Schwab U.S. Dividend Equity ETF is a fund that invests in stocks selected based on their fundamental strengths relative to their peers based on financial ratios. The fund's goal is to track as closely as possible, before fees and expenses, the total return of the Dow Jones U.S. Dividend 100 Index. SCHD was launched back in October of 2011, so almost 13 years ago. The Vanguard High Dividend Yield ETF seeks to track the performance of the FTSE High Dividend Yield Index, which measures the investment returns of common stocks of companies characterized by high dividend yields. VYM was launched back in November of 2006, so it is a much older fund than SCHD. For the sake of this video, these are going to be the metrics that we're going to be looking at for each fund. We'll start by comparing their current yields. As of the making of this video, SCHD currently offers a dividend yield of 3.44%, whereas VYM offers a dividend yield of 3.02%. It should be noted that both these ETFs pay quarterly distributions and none of them pay special dividends. If we compare both yields side by side throughout the last decade, we can see that historically, VYM has been the higher yielding investment. But then after the pandemic, SCHD became the higher yielding investment. It's been pulling out further ahead in terms of offering a better current dividend yield. So in this category, SCHD is going to be the winner. Let's look at the expense ratios for each fund. Vanguard's really well known for offering funds that come with lower than average expense ratios. According to Vanguard's website, the average ETF charges an expense ratio of 0.47%, which is much higher than the typical Vanguard expense ratio of 0.08%. According to VYM's fund page, this ETF currently charges a 0.06% expense ratio, which is even lower than average for a Vanguard index fund and would be considered inexpensive by practically most people. But over on Schwab's website, SCHD also currently charges a 0.06% expense ratio. So it looks like the leaders in the low-cost index fund movement haven't been able to win in the category of cheapest high-yielding ETF. The check is going to have to go to both funds in this category since they both charge the exact same expense ratio. Let's now look at how diversified each fund is. The better the diversification of an ETF, the better, because diversification helps by reducing risk. You don't want all of your eggs in just one basket or in just a few baskets in case one of them fails. All investors should spread their investments across different holdings and sectors. So for this category, the more holdings an ETF has and the more sectors that they invest in, the better. If we look on SCHD's website, we can see this ETF currently has 104 different holdings in it. It has all the popular dividend stocks including AbbVie, Home Depot, Coca-Cola, and so forth. Their largest holding makes up 4.32% of this ETF. Going on to VYM's page, we can see it currently has more than 4 times as many positions at 462. This fund holds nearly all the same holdings as SCHD, and their largest investment makes up 3.24%, which is a bit less than SCHD's largest holding. Looking at their sector breakdown, we can see that VYM's largest sector is in financials at 19.3%, followed by consumer staples at 13.3%, and healthcare at 12.8%. For SCHD, their largest sector is in industrials at 18.3%, followed by healthcare at 15.6%, and financials at 14.5%. I noticed that SCHD doesn't hold many utility stocks, whereas VYM is 7.7% utility companies. So considering VYM has significantly more holdings than SCHD and holds utilities, which are typically known for their dividends, I'm giving VYM the point in this category. Next, we'll look at the tax treatment of the dividends that these funds pay. This is one of the most attractive things about these diversified dividend ETFs, because although their yields are much lower, they not only offer dividend growth, but their dividends are also taxed at a much lower rate. Higher yielding investments like REITs and closed-end funds typically have dividends that are taxed as regular income, but for most consumer staple and telecommunication companies, their dividends are taxed as qualified distributions. You can see a side-by-side comparison of just how big of a difference there is between the tax treatment of qualified dividends versus non-qualified dividends. So for people who hate paying taxes more than anything, these kinds of holdings are going to be a lot more attractive if you're looking for investments to hold inside of a non-retirement account. Going on to Vanguard's website, it says that for the year 2022 and 2023 for the year so far, it says that 100% of their dividend distributions have been qualified dividends. If we look at Schwab's website, it also says that SCHD's dividends last year were 100% qualified, and that'll probably be the case this year. So since both of these funds are paying nothing but qualified distributions, I'm giving both of them the point in this category. So now that we've looked at the current yield, expenses, taxes, and diversification of each fund, let's go a little deeper into the performance of these ETFs. We'll next examine the dividend growth for these ETFs. Which investment has been able to grow their dividends at a faster rate? We'll start by looking at VYM. Here's a chart that shows the growth in their dividend distributions over the last decade. You can see 10 years ago this ETF was paying roughly 43.7 cents per share in dividends, whereas in their most recent quarter they paid 87.7 cents per share. So in the course of a decade, this ETF has been able to grow their distributions by 100.686%, which is really solid. We'll now take a look at SCHD and see what kind of growth this fund has had. Here's the same chart showing the distributions from Schwab's Dividend Growth ETF. We can see a decade ago, this fund was paying 23.1 cents per share in dividends, whereas the most recent distribution was for 66.5 cents per share. We can already see that in the course of 10 years, SCHD has been able to grow their dividends much faster than VYM has. According to my calculation, the amount of growth in distributions provided by SCHD has been 187.887%. Obviously, this is a whole lot better than VYM has been able to deliver up to this point. So in the category of best dividend growth rate, the check is going to have to go to SCHD for offering a significantly higher dividend growth rate compared to the alternative ETF offered by Vanguard. Finally, let's take a look at both investments side by side and see which has offered the better overall return. For this comparison, we're going to look at the overall returns of both ETFs over the last 10 years. Since VYM has been around much longer than SCHD, it wouldn't be fair to go back to their IPO dates for both funds, since VYM would have about a 5-year head start. We're also going to assume that over the last 10 years, all the dividends that were paid by both these funds were reinvested back into the fund, otherwise known as dripping. This helps create a snowball effect that'll significantly increase the overall returns you'll get from each fund. I'll be using the drip calculator over on dividendchannel.com, which is what I normally use for these videos. If we compare SCHD with VYM's total returns from exactly 10 years ago, we can see that for many years both ETFs were in a very close race. But ultimately, SCHD started pulling out ahead after the pandemic occurred. In the span of 10 years, a $10,000 investment in both SCHD and VYM would have given you a return of $29,655.07 from SCHD and $25,291.14 from VYM. That comes out to a total return of 196.61% from SCHD and 152.85% from VYM. From an annual perspective, SCHD gave investors an average annual return of 11.48% compared to VYM's 9.72% over the last decade. So after everything that we've looked at, including the safety and growth of these two ETFs, the winner in this competition is going to have to be SCHD. But I'd like to say that even though SCHD is the winner, both of these ETFs are good investments. They've both offered long-term share price appreciation as well as dividend growth. Remember, these two funds were neck and neck for a pretty long time up until about 3 years ago. When I worked at Vanguard, I knew that they were really serious about trying to keep lowering the cost of these ETFs. So it is possible that someday Vanguard could be lowering the expense ratio on VYM. I don't know how serious Schwab is though at pursuing lower costs on these ETFs. Plus remember, both funds do pay dividends that are 100% qualified as of last year. So ultimately, you can't really go wrong with either one of these two funds. But as we saw, SCHD currently offers a better yield right now compared to VYM, indicating that it might be a better time to get in on this ETF over the other. But on the other hand, VYM is a much more diversified fund, indicating that it might be a safer holding compared to SCHD. So for more risk-averse investors, that might be a better reason to pursue VYM. But if you haven't invested in either of these two funds and you're trying to determine which one is best, my advice would be to make up your decision sooner rather than later. As the old saying goes, time in the market beats timing the market. If you're a brand new dividend investor and one of these funds is going to be your first introduction into this style of investing, don't stress over which one you should stake your financial future on. Both options are solid, and I want to encourage everyone to get started investing as soon as possible. Because when you do that, your dividend reinvestment snowball is going to start earlier, meaning that you'll have even more money available to you on the day you eventually retire. So with that being said, that's going to conclude our comparison of SCHD to VYM. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.